Imagine walking into a shop as a child, not just any shop, but a cathedral of pure, unadulterated joy, a place where every aisle held a promise and every shelf held a possibility. In the distance you could hear the rumble of trolleys, the squeak of plastic, and the high-pitched, giddy laughter of hundreds of children lost in a maze of dreams. That place had one name: Toys R Us. Its mascot, Geoffrey the giraffe, was the ambassador of birthday parties, Christmas mornings, and cherished childhood memories. But here's the chilling truth. Toys R Us didn't die because of Amazon. It did not die because children suddenly stopped playing with dolls or action figures. Toys R Us was the victim of a calculated financial maneuver, a perfect murder, not executed by competition, but by the very system designed to foster growth and stability. It was killed by Wall Street. This is the story of how an iconic American brand and institution, woven into the fabric of a generation, was forced to pay for its own demise. This is the financial murder of Toys R Us. To understand the scale of the tragedy, you must remember Toys R Us dominance. For decades it was the category killer. If you wanted a toy, you went to Toys R Us. By the 1980s and 90s, the company had become a behemoth. Its massive, cavernous stores were strategically located off major highways and were easily recognizable and brimming with inventory. It was the place where every child would drag their parents on a rainy Saturday afternoon. The company was highly profitable. Its brand recognition was almost 100%. It was a giant. So, if a company is profitable, why did it collapse? Because a very specific group of financial predators saw its greatest asset as a liability. That asset was real estate. Toys R Us owned the land and buildings of hundreds of its most valuable stores. In the world of traditional retail, this is financial bedrock. In the world of private equity, however, it's a buffet. Enter the predators of the financial world: private equity firms, specifically Bain Capital, Kohlberg Kravis Roberts, KKR, and Vornado Realty Trust. These firms are not in the business of selling toys. They are in the business of generating enormous returns quickly by restructuring, or in this case, dismantling companies. In 2005, these three titans teamed up to perform a leveraged buyout, LBO. An LBO is a sophisticated and aggressive financial maneuver that uses a large amount of borrowed money to acquire a company. Here is the crucial cannibalistic detail. The debt taken on to buy the company is then loaded onto its balance sheet. Think of it this way. You want to buy a house, but you have no money. Rather than taking out a loan in your name, you force the previous homeowner to mortgage their house and use the proceeds to pay you. The previous homeowner is now left with nothing but a substantial mortgage. In 2005, Bain, KKR, and Vornado acquired Toys R Us for $6.6 billion. The vast majority of that money, over $5 billion, was immediately recorded as debt on Toys R Us' books. Overnight, a healthy, profitable retailer became a zombie corporation whose primary function was servicing that enormous debt rather than selling toys. This financial operation had three cruel consequences that ensured the company's slow, agonizing death. The first consequence was unpayable interest. Suddenly, Toys R Us was legally required to make annual interest payments of over $400 million, and this wasn't the principal sum borrowed. It was simply the cost of borrowing the money. This $400 million had to come out of the cash flow that was supposed to be used for upgrading ancient, warehouse-style stores, building a functioning e-commerce platform to compete with Amazon, and training and raising the wages of staff. Instead of going into the future of Toys R Us, every dollar went straight into the pockets of bondholders and creditors. The second consequence was the management fees. The private equity owners didn't simply walk away and hope for the best. They actively charged the debt-ridden company massive advisory and management fees. Between 2005 and 2017, these three firms extracted hundreds of millions of dollars from the company, essentially charging it for the service of its own suffocation. The company was literally forced to pay its own murderers for their time. The third consequence was the real estate strip. The owners swiftly separated the valuable real estate from their struggling retail operations. They sold the land and buildings under a sale and leaseback agreement. This generated a substantial cash return for the private equity owners in a short period of time. However, this meant that Toys R Us, which had previously owned its premises, was now forced to pay skyrocketing rent to its new landlords, who were often related to the private equity firms, for the same buildings. They had traded a valuable long-term asset for an immediate crippling expense. Critics often claim that Amazon killed Toys R Us. However, this is the narrative that Wall Street loves to promote. In reality, Toys R Us was prevented from fighting back. While Amazon was growing, Toys R Us desperately needed cash to modernize its supply chain, integrate technology, and create a competitive online presence. But the cash simply wasn't available. It was like sending a soldier to battle with no armor or ammunition. Instead of investing in its digital presence, the company had to spend its meager resources on paying interest to KKR and Bain. While Amazon was investing billions and experimenting, Toys R Us was struggling to pay its utility bills. It was a self-fulfilling prophecy of failure, engineered by financial means. Even during the critical holiday season, the company was crippled. Suppliers, wary of the company's substantial debt, demanded much tighter payment terms, knowing it was a bad credit risk. This led to inventory issues, further pushing customers towards the reliable digital giants. The final blow came not from Amazon's website, but from the 2008-09 recession. Families cut back and toy sales naturally dropped. A healthy company could weather a recession. However, a company burdened with $5 billion in debt and annual interest payments equivalent to a mid-sized country's GDP could not. By 2017, the debt burden had become completely unsustainable. After 12 years of private equity ownership, the company had been slowly suffocated. The company had no choice but to file for Chapter 11 bankruptcy protection. The most tragic aspect of the story is the human element. By the time the stores began to close, the financial predators, Bain, KKR, and Vornado, had already exited the situation largely unscathed. They had pulled out hundreds of millions in fees, dividends, and real estate sales. But the 30,000 Toys R Us employees, the cashiers, stockers, and floor managers, who had dedicated their lives to bringing joy to children, were left with nothing. They were not given severance packages. They lost their jobs and their dignity because the private equity owners refused to allocate any money in the final bankruptcy proceedings to support the workers who had generated their profits for over a decade. Public outcry, pressure from politicians, and the tireless work of employee advocates finally forced the private equity firms to create a small fund years later to provide minor relief to the thousands of workers whose lives had been turned upside down. The collapse of Toys R Us offers a devastating lesson in modern finance. It is a cautionary tale that reveals the cold, hard reality of predatory capitalism. When executed ruthlessly, the LBO model proves that it is sometimes more profitable to dismantle a successful, stable company than to fix or grow it. For a select few financial elites, the brand's stability, its employees' livelihoods, and the nostalgia of an entire generation are of little consequence compared to the opportunity to strip the company of its assets and sell them off. The ghosts of Toys R Us and Jeffrey the Giraffe serve as a permanent reminder on Wall Street that, when unchecked by ethics or regulation, financial engineering can turn a sanctuary of childhood dreams into a graveyard of corporate greed. The next time you hear about a large, profitable company being taken private, remember this story. Remember how easy it is to commit financial murder.